Hi, it's been a year of big news stories, and May of 2025 was no exception. On May 16th of 2025, we woke up to the story that Moody's had downgraded the US from AAA to AA+. While this was viewed as groundbreaking news, it was actually the third of the big ratings agencies, and there are three, Fitch, S&P, and Moody's, to downgrade the US. In fact, I remember August of 2011, I was on vacation and I received an email from a reporter, I don't remember, Wall Street Journal, New York Times, and he was pretty frantic. He said, "Did you read the news?" And I said, "I'm on vacation, I don't read the news." And he said, "S&P has just downgraded the US from AAA to AA+. There was a period of turmoil, but that passed. In fact, I wrote a post in 2011 that some of you might be able to find online somewhere about that ratings downgrade. And my reaction was, chill, it's not the end of the world. S&P remained an outlier till 2023 when Fitch joined S&P and downgraded the US as well. Now, incidentally, both S&P and Fitch pointed to two factors in the downgrade. One was that the US was increasingly becoming debt-ridden. The US government had more debt. And the other was the political dysfunction that they thought could lead to a default. That left Moody's as the odd man out. And of course, in May of 2025, they joined the crowd and downgraded the US as well. It happened after close of trading on Friday, and there was a lot of hemming and hawing about what the markets would react to or would open up to on Monday when they did open. Now, we'll complete that part of the story, but before I do that, I need to lay the foundations for what sovereign ratings are, how they're assessed, and what they actually measure. So let's step back. Sovereign defaults have been part of financial history. What are sovereign defaults? Countries borrowing money and being unable to pay that debt back. Of course, if you look at the history of defaults, Latin America has been the epicenter, but defaults have occurred all over the world, and Europe, North America, and Australia have been the exceptions. Now, if you look at sovereign defaults over time, the number of defaults ebb and flow depending on the state of the global economy. This is global debt in default from 1990 to 2023, and you can see that defaults are widely spread across the world. Now, you can see why governments default when they borrow in a foreign currency. India borrows in US dollars, or Brazil borrows in euros, and it's unable to raise enough foreign currency to pay the debt back, it can default. But one of the most interesting features of sovereign default, especially in recent decades, is that an increasing percentage of the defaults have been local currency defaults. And that puzzles people. And why? And here's the reason local currency defaults, at least in theory, should not happen. It's a local currency. So if you're short of currency to pay off debt, what do? You run the printing presses a little faster. You print off enough currency to pay off the debt. In theory, a government should not default in local currency debt. But obviously they do. And to see why, think about the choices you face if you're a government facing an incredible amount of debt in local currency coming due. It is true you can print the money off and pay off the debt. But if you do that, you open yourself up for inflation, perhaps hyperinflation, or you can default. You're between a rock and a hard place. Hyperinflation ruins faith in your currency, could make it very difficult for you to come back, and default creates its own consequences. And governments across time have decided, at least some governments have decided, it's easier to come back from default than it is from hyperinflation. But whatever the reasons, default creates consequences. First, not surprisingly, when governments default, there is a negative impact on the economy. Real GDP drops by 0.5 to 2% in the aftermath of the default. It does affect the country's long-term rating and its capacity to borrow money and the cost at which it can borrow money. It can also cause trade retaliation. When you default, it may be more difficult for you to trade with other partners. Makes banking systems more fragile. And finally, and this is something to factor in, sovereign default increases political dysfunction, the likelihood of political change. So over time, governments have thought long and hard about defaulting, but in spite of all of those disadvantages, sometimes governments do default. Now, of course, the measure used for sovereign defaults across the world, in much of the world, still remains sovereign ratings. Let's step back. The big three ratings agencies in the sovereign ratings game are S&P, Moody's, and Fitch, and they all made their reputation by rating companies. What they effectively did was they took that ratings process, they rate companies from AAA, safest companies, down to D in default, and they brought into the sovereign space. And it's been in recent decades that you've seen the growth in sovereign ratings. In fact, in 1985, and I'm focusing just on Moody's since Moody's was the one that downgraded the US, in 1985, Moody's was rating only 13 countries, and 11 of them were AAA rated. So it was all the big US, much of Europe. But there weren't very many sovereign ratings. And since 1985, in the last 40 years, you've seen an explosion of sovereign ratings. In fact, by 2025, there are 143 countries with sovereign ratings. Incidentally, the number of AAA ratings has stayed at 11. In fact, the number of AAA ratings, I think, peaked around 15 or 16 around the middle of 2005, 2006. And in the last 15 years, about 3 or 4 of those AAA rated countries, and the US being the latest one, have lost their AAA ratings. The UK is no longer AAA rated. Japan led the game by being the first AAA rated country to drop off. France is not AAA rated. So we've lost a bunch of AAA rated countries over the last 2 decades. So sovereign ratings have exploded. Now, how do these ratings agencies assign a sovereign rating to countries? If you go to the Moody's website, they're pretty open about what they look for. They look for fiscal strength. How strong is a country economically? They look at the institutional strength. How strong are the institutions that back up the borrowing? So economic and fiscal strength go in there. Politics goes in there. And they also look at the susceptibility to event risk. What does that mean? If you're a country that is extremely exposed to a single commodity for your economic growth, a drop in the price of the commodity can expose you to risk. So that gets factored in. So basically, the ratings agencies start with mostly quantitative factors capturing these. They come up with a score. And then they're open about the fact that they bring in what they call other considerations, soft factors into play in assigning a rating to the country. So ratings agencies basically bring the mechanism they develop for corporate ratings into the sovereign rating process. And at the start of 2025, if you looked around the world, you could see that sovereign ratings, the disparity of sovereign ratings across the world. First, notice the gray shaded areas. Those are the parts of the world which have no rating. So a chunk of Northern Africa is still not rated. Russia, which used to have a rating till 2022, had its ratings withdrawn by all the major ratings agencies in 2022 and has not been rated since. But if you look across the rated world and you look at the green sections, these are the highest rated countries, AAA, and this was the start of 2025. You see the US, you see Canada, start of 2025, Australia, portions of Northern Europe, not Southern Europe anymore, portions of Northern Europe, Germany, and the only AAA rated country outside of there was Singapore. As I said, there aren't that many AAA rated countries, and the US was one of those AAA rated countries, at least according to Moody's at the start of 2025. If you look across the rest of the world, you can see the hotspots of country risk, at least from the ratings agency's perspective, Latin America and Africa. Asia has become increasingly safer, at least according to ratings agencies over the last 2 decades, with China becoming light green and India approaching light green over time. That was the start of 2025. And of course, there have been ratings agencies in 2025. In fact, there have been 8 upgrades and downgrades, 4 upgrades, 4 downgrades in 2025. The US had the most new story attached to it, downgrade from AAA to AA+. Greece has been one of the success stories. It's gone up from a BA1 rating at the start of 2025 to Baa3, and that's been a rise that's been going on for almost a decade now. But you can see the split between upgrades and downgrades. Now, if you look at what sovereign ratings is supposed to measure, they're supposed to measure default risk. And do they do a good job? At least on the surface, they do. In fact, all of the ratings agencies have a table similar to this one, which is from Moody's, that measures what percentage of sovereign rated countries with a rating default within 1 year, 2 years, 3 years. So let's take AAA rated sovereigns. They never default. AA rated, they default about 0.71%, less than 1% default within 10 years. And as you go down, clearly the lower the rating, the greater the likelihood of default. So at first sight, it looks like ratings do what they're supposed to do, which is measure default risk. They're highly correlated with default risk. Now, in fact, investment grade rated countries, which is Baa1 and above in the Moody's rating scale, only 1.8% of those default. But if you're speculative grade, which is below Baa1, about 24% default. So at least, on the surface, sovereign ratings measure default risk. But before you celebrate, there are some caveats. There is an argument that maybe sovereign ratings are upward biased, and there's a bias story for it, which is there are some sovereigns which pay for their ratings, and if you're the ratings agency, you don't want to make those sovereigns angry, so you don't rate. That story might have some heft in the corporate rating space, not much in the sovereign rating space, because first, sovereign ratings are not a huge source of revenues. There are very little in revenues that the ratings agencies get. And second, a significant proportion of sovereign ratings are not solicited. They basically are ratings that the ratings agency assigns, the country doesn't pay for them. So if they're upward biased, there's very little evidence that you can present that's tangible to back that up. There is herd behavior. When one ratings agency downgrades a country, there's often a rush of other ratings agencies to do the same, which makes ratings collectively less valuable because it'd be nice if each ratings agency were independent of the other. The third, and this is my biggest concern with ratings, is they're often too little too late. Now, Greece started getting into financial and economic trouble in 2009, but by the time ratings agencies downgraded Greece in 2011, everybody knew there was a ratings problem. So if we go back to the previous table, which showed that correlation, it doesn't tell you whether the correlation is timely, because after all, if you're using sovereign ratings as an investor, as a lender, you want it to be a signal of changes in the future, not a signal of what's already happened. And there is this concern that sometimes a ratings downgrade can make a problem even worse. This is especially true for smaller countries that are heavily dependent on borrowing money outside. If you downgrade that country, you can create an economic collapse, which makes it even more difficult for the country to get out of the hole it's in. And in much of the emerging market space, there is this feeling, fair or not, that ratings agencies are too easy on European and North America, Australia, the traditional developed markets, and too tough on emerging markets when it comes to ratings, that they underrate Asian, Latin American, African countries, and that is a concern worth thinking about. So ratings agencies are correlated with default risk, but they're not very timely measures of it. So wouldn't it be nice if you could get a measure that was timely and updated constantly? And there's a market-based alternative, and it's emerged primarily in the last 2 decades, called the sovereign CDS market. It's got its imperfections, which is you often have counterparty risk, there's frictions in the market, but it is an advantage to have this market because it gives you constantly updated measures. What's a sovereign CDS? It's a market where you can go to buy insurance against default risk. So let's take an example. Let's take Brazil. Let's say you bought a Brazilian government bond and you were worried about default risk. And the Brazilians, let's work with the dollar market. You bought a Brazilian dollar-denominated government bond, paying let's say 8.5%. You're concerned about default risk. You can go to the sovereign CDS market and buy protection against the default risk, insurance. You have to pay a portion of the 8.5%. How much? If you look at the price for the sovereign CDS at the start of 2025, 3.23% of the 8.5%. And if you pay that, effectively you're insured against default risk. So it's an annualized cost of default risk, and it's actually an alternative you can use for sovereign ratings. The advantage of a sovereign CDS market is it's updated constantly. The disadvantage is the market number. It's going to be much more volatile than the sovereign ratings base spread. So pluses and minuses. So with that lead in, let's talk about the US downgrade. If you look at Moody's rationale for the downgrade, it was no surprise. In fact, it was the same 2 reasons given by S&P and Fitch in the decade prior for their downgrades. And one of the key factors was what they pointed to as the rising debt level. So if you look at federal total debt in the US as a percent of GDP, clearly it has spiked in recent decades. But that spike is not new. It started in 2020. And the question you have to ask is, why now? I mean, why downgrade now? Why not in 2021 or 2022? So we're already setting in the pieces for the downgrade. And you can see that wasn't a surprise. In fact, if you look at the rise in federal debt, it's been gradual. It's been in bumps over time. You start in the 1980s, there was the initial rise. 1990s actually at a period where debt leveled off, and then post 2008 you see the debt take off. That 2008 crisis was in fact the trigger for a surge in federal debt in the US. So if this was the trigger for the downgrade, there was nothing specifically that happened in 2025 that should have led to the downgrade. This was long in the making. Keep that in it. But before you get too carried away with this debt to GDP ratio, it's a very flawed measure of default risk. If you look at the countries which had the highest debt to GDP in 2020 and the latest numbers we have for 2023, and the lowest debt, and you look at that list and you look at the list of countries with the highest debt, many of them are countries that you think of as safe countries. Look at the countries with the lowest debt. Many of them are the riskiest countries in the world. So by itself, debt to GDP is a flawed measure of default risk, but it's a measure that the ratings agencies look to, and it is a concern in the US. Now, of course, while the effect of the ratings itself might not have been a surprise, there is a symbolic factor, which is you could hold on to the Moody's AAA rating for as long as it exists and say, hey, there's at least one ratings agency that's giving it a AAA rating. You no longer have that fig leaf. In fact, I would argue that for decades now, the US has had a special status with markets and institutions, allowing it to do things that other countries couldn't have gotten away with it. US exceptionalism. And the Moody's downgrade to me seems to be a signal that those days are winding down. Again, this is not the action, it's been a collection of actions, but that symbolic effect will outlast whatever you see in markets. But if you look at the market effect itself, it was muted. I mean, look at the stock market, for instance. You look at the Moody's downgrade, we opened up on Monday, actually markets going up. And the week after, markets did go down, but much of that was driven by bills working their way through Congress that might have an effect on debt and deficits. And by the end of May of 2025, markets had completely recovered whatever they'd lost because of the downgrade. At least for equities, the effect of the downgrade seems to be null to very little. You say, what about the US Treasury market? Again, the effects were very mild. There was an initial little bump at least in the long-term rates, the 20 and the 30-year rates. But look at the change since 5/16 was the date. The change has been, it's almost trivial. So neither the equity market nor US Treasuries have reacted very much to the downgrade. And that might seem like a surprise to you. But it didn't surprise me for a few reasons. One is, remember, the reasons Moody's pointed for the downgrade have been there for a decade. S&P and Fitch have already downgraded. So this wasn't a surprise that the downgrade was coming. The question was not whether, but when. Second, Moody's actually has this additional component to a rating called an outlook. The outlook can be positive, stable, or negative. Stable basically means the rating, they're pretty comfortable with the rating. Positive means they're thinking about an upgrade, and negative means they're at least thinking about a downgrade. Doesn't mean the downgrade always follows. The US was put on was given a negative outlook in November of 2023, about 2 years ago. So this has been cooking for a while. It shows you how long it takes for ratings agencies to actually act. It might explain that too little, too late phenomenon we notice with ratings. Second, while some markets a downgrade has an immediate effect on borrowing costs, especially if we're very dependent on governments raising capital, the effect is going to be much greater. The market like the US, we have immense amounts of private capital that'll flow into equities and debt no matter what the US rating is, at least for a band in the rating. In fact, the ratings change from AAA to AA1 still leaves the US with a very high rating. In fact, the difference in default spreads between a AAA rated country and a AA1 rated country is but 0.15%, 0.2%. So small change, no surprise, and this in a market where there's a huge host of private capital, the effects are not surprisingly small on markets. But the question, and I teach corporate finance and valuation. To me, there is this question of practice. How does this downgrade affect the way I practice corporate finance and valuation? And there is this irritant effect that is created. It's going to make my life a little messier in terms of estimating risk-free rates and equity risk premiums. And let's talk about what that effect is going to be. Let's start with the risk-free rate. A risk-free rate, at least in theory, is the rate at which you can borrow money on a guaranteed investment. Now, why do you need a risk-free rate? Because everything else in finance is built off a risk-free rate. To get an expected return on a risky investment, you need to start with the risk-free rate. Now, I don't know about you, but I was taught corporate finance with the notion that the government bond rate was the risk-free rate. Of course, I was taught in a very US-centric environment. The US Treasury rate was the risk-free rate. Implicit there is the belief that the US Treasury is default-free. Now, of course, if you have a default-free government, you can use the government bond rate as the risk-free rate. Earlier, I noted that governments often default in the local currency. So we have to open the door that a government bond rate might not be default-free. Now, at the start of 2025, my lazy definition of default-free was if a government was AAA rate was default-free. So start of 2025. If you ask me what the risk-free rate in US dollars was, I took the US Treasury rate and used that as my risk-free rate, using the excuse that Moody still attaches a AAA rating to the US. In fact, there were only 11 governments where I could attach a government bond rate as the risk-free rate, and those are the 11 AAA rated governments at the start of 2025. You say, what about the rest of the currencies? There I start with the government bond rate and I net out a default spread for that government based on its rating. So you're a Baa1 rated country with a 1% default spread. I subtracted the 1% from the government bond rate to get to risk-free rate. So in this graph, the height of the column gives you the government bond rate. The red is the default spread, and I'm netting it out to come up with the green, which is the risk-free rate by currency. Not a big deal, but it's a pain in the neck. To get the process started, you have to estimate a risk-free rate. So in May of 2025, I no longer have the fig leaf of Moody's giving me a AAA rating for the US Treasury. So if I were doing a risk-free rate in US dollars, here's what I'd have to do. I'd have to start with the government bond rate. Let's say the 10-year Treasury bond rate, May 30th of 2025, is 4.41%. I'd have to look up a default spread in a AA1 rated country. I can do that either by looking at countries like Austria and Finland that are AA1 rated and comparing them to the German euro bond rate, because they both borrow in euros. That spread is about 0.4%. Or I can go to the sovereign CDS market and look at the spreads there, and it's about 0.4%. So basically, I subtract the default spread from the 4.41%. I get a risk-free rate in US dollars of 4.01%. Now, of course, when I do that, I'm acting on the presumption the market was completely surprised by the May 16th downgrade. But that's probably not true, right? Markets, if they know, have been probably assessing some default spread in the US Treasury all the way through, and we've probably been overestimating the risk-free rate in US dollars as a consequence leading into May 16th. So the risk-free rate is going to be lower. You think that's good, right? Not necessarily, because there's another piece at play, which is the equity risk premium. Again, let me go back to how I estimated equity risk premium at the start of 2025. I estimated the implied equity risk premium for the S&P 500 by taking by taking expected cash flows on the index and backing out what the expected return on stocks is given how they were priced. That premium is 4.33%. Start of 2025, because the US was still AAA rated, I'm holding on to the Moody's rating, for every AAA rated country, I gave it the US equity risk premium, saying that's a mature market premium. If you're not AAA rated, I took the US equity risk premium and I adjusted your default spread relative to AAA rated bond for the fact that equity is riskier than debt, 1.35 times riskier. So that was the start of 2025, and that's how I came up with the equity risk premiums by country. You're saying, what's going to change? Well, January 1st, 2025, that 4.33% shows up wherever you have a AAA rated country. So if you look across this page, and it's kind of blurry, but you can see the full page, full spreadsheet on my webpage. Every AAA rated country got a 4.33% premium. Every country with a rating below AAA ended up with an additional risk premium. That's a red number, which got added on. Now let's see how that would change. And this is something I have to start thinking about. If I were doing this today, I'd start by estimating an implied equity risk premium of the S&P 500, which is what I do at the start of every month. End of May 2025, that implied expected return on stocks was 8.64%. So basically, I backed out the expected return on stocks given the cash flows. So that's what stocks are priced to earn, 8.64%. Remember at the start of 2025, I subtracted the T-bond rate from it. I can't do that anymore. Why? Because the T-bond rate is no longer risk-free. So rather than subtract out the 4.41%, which is the T-bond rate, I subtracted out the adjusted risk-free rate, 4.01%. My equity risk premium is now 4.63%. See what the trade-off is. I have a lower risk-free rate and a higher risk premium. But it's now going to affect how I compute equity risk premiums to the rest of the world. Why? Because there are 10 countries now with AAA ratings, which the US no longer has. For those countries, I'm going to give them a lower equity risk premium than the 4.63%. I'm going to take the 4.63% and subtract out the additional risk premium that I have for the US based on its rating, which is about 0.52%, which means my mature market premium is no longer the US equity risk premium. It is this 4.11%, which is this adjusted number. And for every other country now, I build off that mature market premium of 4.11%. What is that going to mean? The US is no longer going to share that lowest equity risk premium with the other AAA. It's going to have a higher equity risk premium than Germany, Australia, Canada, and it is going to come with lower risk-free rates in US dollars. Now you're saying this is a pain in the neck. So I did compute what a cost of equity would look like for a typical company with all of its revenues in the US. At the start of 2025, if I'd use the pre-downgrade numbers, so basically I'm taking the end of May 2025 and acting like there was no downgrade, I'd have been using the T-bond rate as my risk-free rate, 4.41%. My 8.64% wouldn't have changed. That's an internal rate of return. But instead of subtracting out 4.01, I'd have ended up with a lower equity risk premium. So if this downgrade had not happened, my equity risk premium that you'd have seen reported for the US would have been 4.23%. If you're an average risk stock, and I'm using beta as kind of a proxy for it, my expected return would be an 8.64% risk-free rate plus equity risk premium. If I were a safer stock, let's say I'm 0.8 times as risky as the average stock, my expected return would have been 7.79%, which would be the risk-free rate, 4.41%, plus 0.8 times 4.23%. Riskier stock beta 1.2, risk-free rate 4.41%, plus 1.2 times 4.23% would have given me an expected return of 9.49%. So without the downgrade, that's what my numbers would have looked like. With the downgrade, my average risk stock has exactly the same return. The composition of that return has changed. Lower risk rate, higher risk premium. The safer stocks have slightly lower expected returns now, and my riskier stocks have slightly higher expected returns. The bottom line is the change is almost trivial. So that's good news. If you're an analyst and you've been using the US Treasury rate as your risk-free rate, and an equity risk premium as the extra return over and above the Treasury rate, you can probably keep doing that. The effect of this downgrade is so small you won't even notice the difference. But that could change if the AA1 becomes AA3, AAA3, BAA1. So in a sense, we've opened the door now to potentially having to adjust US dollar risk-free rates and equity risk premiums. I will continue to use the US Treasury rate as my risk-free rate in US dollars. But as I compute equity risk premiums starting with the middle of this year, I will now incorporate the fact that there are countries now which will be safer than the US in terms of equity risk premiums, and I will be consistent in my equity risk premium computations. What are the financial and economic consequences? As you can see from the downgrade, they're probably minimal because there was not much of a surprise factor in them. The effect on cost of equity will be fairly small, so you can continue to do what you were doing in US dollars without any major changes. With all of that said, I talked about the symbolic effect. I think that symbolic effect you have to keep an eye on, because it might reflect that final adjustment, assessment that the US is no longer given special status, that the US cannot get away with doing things that other countries could not do. And I think that's healthy, not just for the US, but for the rest of the world, for the US to have to be accountable for actions that was getting away with because it was the US. I hope you found the session useful, and I thank you very much for listening.